Hi, welcome to Jared Invests. Today we are going to be discussing about 10 credit score myths that nearly every 20-year-old actually believes are true. A bad credit score will cost you $56,103 on a single mortgage. Not over multiple loans, not across your whole life. One house, one mortgage. Just because your score was 620 instead of 760. That's not a rounding error, that's a car. That's a year of rent. That's money gone because of a number most people your age barely understand. And here's what makes it worse. Most of the damage isn't happening because people are irresponsible. It's happening because people believe things that are flat out wrong. Myths. Stuff that sounds logical, gets repeated by friends and family, and quietly destroys credit scores for years before anyone figures out the truth. 10 myths. All of them common. Several of them believed by the majority of people in their 20s. Every single one has a real dollar cost attached to it. Before you tell yourself your credit is fine, hold on. Because 43% of young people think using a debit card builds credit. They genuinely believe they've been working on their score for years. They haven't touched it once. And 36% of young people actively avoid checking their own credit score because they think it will hurt them. So they have no idea what's actually in their report. Wrong on the myth, blind to the reality. That combination is expensive. And if you're thinking, I don't even need credit, you will. You'll need it for a mortgage. You'll need it for a car loan. Most landlords pull your credit report. Some employers do too. Your car insurance rate is partially determined by your credit score in most states. A 105% higher premium. That's not hypothetical, that's a published actuarial reality. The idea that you can opt out of the credit system and coast through life unaffected is one of the most expensive beliefs a 20-year-old can hold. So let's go through all 10 myths. The belief, the truth, and what it actually costs you. Myth number 1. Checking your own credit score hurts it. The myth is so widespread it has a name, credit score anxiety. And 36% of young people won't check their score because of it. The logic makes sense on the surface. Something checks your score goes down. Sounds right. It's wrong. Two types of credit inquiries exist. Hard inquiries happen when a lender pulls your report to make a lending decision. You apply for a credit card, a car loan, a mortgage. Those can drop your score 5 to 10 points, temporarily. Soft inquiries are everything else. You checking your own score, pre-approval checks, background checks. Soft inquiries carry zero impact. None. Checking your score on Credit Karma, through your bank, through annualcreditreport.com. Completely harmless. The cost of this myth isn't a direct number. It's the cost of flying blind. If there's an error on your report, a collection account that isn't yours, a late payment marked incorrectly, a card you never opened, you have no idea. 1 in 5 credit reports contains an error significant enough to affect the score. 1 in 5. If you're in that 36% who never checks, you could be carrying damage you didn't cause and don't know about. Disputes take time. The earlier you catch it, the less it costs you. Myth number 2. You need to carry a balance to build credit. Carrying a balance has been draining real money from people every single month because of this one. The idea is that credit card companies want to see you using credit, and carrying a balance shows you're a real borrower. It sounds plausible. It's completely false. Payment history is 35% of your credit score. Scoring models register on-time payments whether you pay $12 or $1,200 at the end of the month. Paying your statement balance in full builds credit identically to carrying a balance. Identically. Zero scoring benefit to carrying debt. The cost of this myth is pure interest. The average credit card APR right now is 24.92%. If you're carrying a $2,000 balance because someone told you it builds credit, you're paying roughly $498 a year in interest charges. For nothing. For zero credit building benefit. Over 5 years, that's nearly $2,500 handed to a bank based on a myth someone told you at a family dinner. Pay your statement balance in full, every month. Your score doesn't care about your balance. It cares about whether you pay on time. Myth number 3. Closing old credit cards improves your score. The thinking goes, fewer cards, less temptation, cleaner financial picture. It's the kind of advice that sounds responsible. In practice, it almost always backfires. Your credit score runs on 5 factors. Payment history at 35%, credit utilization at 30%, length of credit history at 15%, credit mix at 10%, new credit at 10%. When you close an old card, you hit 2 of those factors simultaneously, and not in a good way. Length of credit history counts your oldest account, your newest account, and the average age of all your accounts. Close a card you've had for 6 years, and that average drops. Your score drops with it. On top of that, closing a card wipes its credit limit from your total available credit. Less available credit with the same balances means your utilization ratio jumps. Higher utilization, lower score. The move isn't to close the card. If it has an annual fee and you're not using it, call and ask to downgrade to a no-fee version. Keep the account open, keep the history, keep the limit. Zero cost to maintain, real cost to close. Myth number 4. Your income affects your credit score. Simple 1. And wrong. Your income is never reported to the credit bureaus. Experian, Equifax, TransUnion, none of them know what you make. Your credit report holds your payment history, your balances, your account ages, your inquiries, and any public records like bankruptcies. Your salary is not on there. Your hourly rate is not on there. A freelancer making $40,000 and a surgeon making $400,000 can carry the exact same credit score if their credit behavior is identical. A lot of people in their 20s think they can't build good credit until they make more money. That's not how the system works. You can build an 800 score on a $35,000 income. The score measures how you manage what you have, not how much you have. Myth number 5. Using a debit card builds credit. 43% of young people believe this, nearly half, which means close to half of the people your age who think they're building credit with every swipe are actually doing nothing for their score. Debit cards pull from your checking account. No credit is extended. No lender is involved. No account gets reported to any credit bureau. The transaction is invisible to the scoring system. Every time you tap your debit card at a coffee shop, at a grocery store, on a streaming subscription, your credit score doesn't move a single point. If you're in your early 20s and your whole financial life runs through a debit card, your credit history is probably thin or non-existent, and thin credit history makes it harder to get the rates you'll want when you actually need them. The fix is straightforward. Get a starter credit card, put 1 or 2 small recurring charges on it, pay it in full every month, and let the history build. That's it. That's the whole strategy. Myth number 6. You need an 850 credit score to get the best rates. People chase 850 the way people chase a perfect GPA. It's a psychological goal that doesn't correspond to any real-world reward. Here's how mortgage and auto lenders actually operate. Once your score crosses the 740 to 760 threshold, you're in the top tier. You get the best rates. The gap in interest rate between a 760 and an 850 is negligible, sometimes zero. Lenders don't offer a special premium rate for perfection. The tier maxes out well before 850. Spending months obsessing over pushing a 790 to an 820 when you could be focused on building income, investing, or just living your life is a flat-out waste of energy. Hit 760. Get the best rate. Move on. Myth number 7. You only have one credit score. You have dozens. 60-plus FICO score versions exist, plus multiple Vantage score models. FICO 8 is the most commonly used general-purpose score. That's what most credit cards use. But mortgage lenders pull FICO 2, FICO 4, and FICO 5 from 3 different bureaus. Auto lenders often run FICO Auto Score 8, and the score you see on Credit Karma? That's a Vantage Score 3.0. It's a real score, but it's not what your mortgage lender is pulling. Here's the practical piece. Don't assume the number on a free app is the number a lender will see. It's directionally accurate. If your Credit Karma score is 740, your FICO 8 isn't going to be 580. But the exact number can shift by 20, 30, sometimes 50 points depending on the model and the bureau. When you're preparing for a major loan, pull your actual FICO scores from myfico.com. Know what the lender knows. Myth number 8. Student loans only hurt your credit. Student loans feel like a burden because financially, they often are, but their effect on your credit score is more layered than most people realize. Student loans expand your credit mix, which accounts for 10% of your score. Having a variety of account types, revolving credit like cards, installment loans like student loans or car loans, shows lenders you can handle multiple kinds of credit. More importantly, every on-time payment on a student loan builds payment history. That's 35% of your score. If you've been paying your student loans consistently, you've been building the single most important factor in your credit score, whether you knew it or not. The damage only comes when payments are missed or deferred incorrectly. A student loan in good standing is a credit asset. Treat it like one. Myth number 9. Paying on time is all that matters. Payment history is 35% of the score. Important, yes. But 35 out of 100 is not all that matters. The second biggest factor, credit utilization, runs 30% of the score. And utilization trips up on-time payers constantly. Utilization is the percentage of your available revolving credit that you're currently using. You have a $5,000 limit on one card. You're carrying a $4,000 balance. That's 80% utilization. Even if you've never missed a payment in your life, 80% utilization will drag your score into mediocre territory. Scoring models read high utilization as a signal of financial stress. You're using most of what you have available, which statistically correlates with higher default risk. Paying on time while ignoring utilization is like eating clean all day and then wondering why your health isn't improving, because the other half of the equation is pulling you down. You need both. On-time payments and low balances working together. Myth number 10. Keep your utilization under 30%, that's the target. Call this one the most frustrating myth on the list, because it's technically not wrong. It's just incomplete in a way that costs people real points. 30% is the danger threshold. It's the point where your score starts taking real damage. But under 30% is not the goal, it's the floor. To hit the highest scores, the actual target is under 10%. Single digits. People who score above 800 consistently tend to carry utilization in the 4% to 7% range. That's not an accident. If you have a $10,000 credit limit total across all cards and you're carrying a $2,800 balance, you're under 30%. You're not getting penalized, but you're leaving points on the table. Drop that balance below $1,000 and your score will reflect it within a billing cycle or two. The 30% rule tells you where the cliff is, not where to stand. Now step back and look at what these myths actually cost when they stack up. Myth 2. Carrying a balance at 24.92% APR when you don't have to runs you roughly $500 a year on a $2,000 balance. Over 10 years of early adulthood, even accounting for some payoff periods, that's potentially $3,000 to $5,000 in unnecessary interest. Myths 9 and 10 combined. Paying on time but running 60% to 80% utilization, never pushing your score above 680. When you go to buy a car at 680 versus 760, on a $30,000 auto loan you're paying $9,500 more over the life of that loan. That's published rate data. And the mortgage. If those same habits hold your score at 620 when you finally buy a home, the extra cost on a $300,000 mortgage compared to a 760 score is $56,103 just on interest. One house. Add those three together. You're looking at well over $65,000 in additional lifetime costs. Not from being irresponsible, from believing myths. Here's what to actually do this week. 3 moves. First, check your credit score and pull your full report at annualcreditreport.com. Free. No impact on your score. Look for errors. Dispute anything that's wrong. Do it now, before you need a loan. Second, if you're carrying a credit card balance right now for no reason other than you heard it builds credit, pay it off. All of it. Your score will climb within 30 to 60 days, and you'll stop paying 24.92% APR for nothing. Third, check your utilization. Add up all your balances, divide by your total credit limits, and see where you land. If it's above 10%, you know exactly what to work on. None of this is complicated. The credit system isn't complicated. What's complicated is unlearning the myths that got handed to you before you even had a chance to ask the right questions. Subscribe to the channel if you enjoyed the video.